Hey guys, Sean here. Recession warnings are lighting up everywhere and everything seems to be crashing real hard. Stocks are down, silver's getting smashed, and gold has taken a nasty dip and many of us are feeling a little fearful. Why is gold dipping when inflation is still soaring? But more importantly, is this just a simple recession or are we going to plunge into a deflationary spiral where everything across the board plunges? I think before we even think about buying or selling gold, we need to take a step back and understand what is causing this bloodbath. And in this video, I really want to talk about staying calm during this period and really answer the question of if it's a good time to keep buying gold or maybe it's smarter to wait for another dip. First things first, it's really quite simple to understand why a recession is hitting us today. For far too long, interest rates have been near zero for almost 12 years and we are getting too used to loads of easy money. Money printing has pushed asset prices higher, companies are going around borrowing money at record low rates, and everyone got their free stimulus checks to spend on junk and crap. But things have changed, right? The Fed has announced a tightening of 50 basis points in May, and in a double whammy, they are going to offload their balance sheet and start selling almost $100 billion worth of bonds a month. Now, this quantitative tightening is a big shock, and the market is having a knee-jerk reaction. Everything is selling off, but we are truly in a weird situation where inflation is still sky high, food prices are still going up thanks to shortages and supply chain issues. Now, I've mentioned this before in my previous video where we will see an inflationary hell while deflation will happen in certain sectors. But why is gold getting hammered, right? Shouldn't people flock to precious metals to preserve their wealth? Well, normally it should, but we aren't living in normal times and we need to take a look at why. And it all has to do with the US dollar gaining strength. Yes, I know it's weird. The United States has been putting up all this funny money for years and years, and people are actually viewing the dollar as a safe haven. Now, I want you to visualize a bunch of ships and each of them represents a currency. Now, every currency is essentially a sinking ship. They all lose purchasing power over time and they are all sinking together. But now one ship, the USD, is plugging their holes and reducing the amount of water coming in. So it's still bobbing up and down a little while the rest of the other ships are sinking. Now, don't get me wrong, the American ship is going to sink sooner or later, but while the other ships are sinking, it makes total sense for the people, the survivors on board, to swim to the US vessel that's still afloat. And that is exactly what's happening to the US dollar. The Fed is tightening and raising interest rates, making the dollar look more attractive and responsible versus other currencies. Just look at Japan. Their currency has been devalued thanks to the Bank of Japan's fascination with money printing and near zero interest rates even while their inflation is climbing. This causes investors in general to look at the USD as a better option, and it's all relative. And when the US dollar gains in strength, gold gets weaker because it's priced in US dollars. Just take a look at the bond yields which have hit 3%. That's a 4-year high, and investors are now thinking, right, hey, why should I take a risk in the stock market if the Fed is pulling away all this liquidity? The stock market is about to plunge, so I'd rather just run to bonds and earn 3% instead of losing money. It's very weird kind of thinking, but that's probably what's circulating around Wall Street. But how long can this charade last? Remember that real interest rates are still negative, and when bond yields rise, so is the burden of servicing the US debt that's over $30 trillion today. So what will happen to gold during this period? We are in an interesting time because on one hand, people are running away from the stock market while inflation is still raging on. And we are seeing crazy overvalued stocks like Netflix, Amazon and Teladoc just getting hammered down, and I think this shows us two big things. Firstly, I think investors are regaining some sanity and are now looking at valuations. They are assessing what an asset can actually bring today and not some pie in the sky hope and dream of what it can bring tomorrow. Easy money is now gone and consumer behavior has really shifted big time, right? The non-essentials are being dumped and we are all now focusing on putting food on our table. I mean, just for myself, I'm spending less money on discretionary stuff like heading to the movies or, God forbid, buying some Netflix subscription. More of our money is going to food and fuel, the essentials of life, and just take a look at this Business Insider article, right? Fast food workers say they are facing more harassment than ever as angry customers lash out in response to rising food prices. Now, people are getting really angry and we need to look at the inflation angle. Yes, asset prices will likely continue to decline, But where will the money eventually flow once it leaves the stock market? We need to think a little deeper here. Yes, it can run to bonds, but the real interest rate is still negative. And if bond yields rise too much, it could force the Fed to U-turn and start easing, which means lowering interest rates and printing money once again, or face an impossible debt to service. And gold will benefit from that. But the big question is, when will that happen? Now, no one can say it will happen in a month, in a year, or even in 3 years, which means there will be continued pressure and headwinds on the gold price. Now, the big question is, should you stay in cash or buy gold? Because obviously the stock market is looking like a house of cards, P/E ratios are still high, and prices could come crashing down to earth. But staying in cash is still a problem as well when inflation is sky high and there's only so much food and supplies you can buy, right? Now, the thing is to understand that even when a deflation happens, gold still retains purchasing power when measured in terms of assets it can buy. After the 2008 crash, gold and the S&P 500 both fell in prices, but gold actually gained in purchasing power. You could buy more of the stock with an ounce of gold. Gold actually gains strength. So your buying decision really has to depend on your motivation and where you are in your stacking journey. If you already have a nice stash of gold, you can definitely afford to wait it out and see what happens from here, and if the Fed will really commit all the way and hike to 3.5%. Will it happen? We can't say for sure, right? What we can say is that there will be lots of volatility because tightening is very different from easing, right? Where interest rates are low and money is being printed, all asset prices go up and people are cheering and buying, and it will take some time for the daily effects of inflation to show. We know this by now. But when it comes to tightening or deflation, any small dip breeds fear, and fear is very contagious, right? Now, if you're new to gold or looking to beef up your stack, then it's not a bad time to buy some as well. There will be opportunities to pick up some during those big dips, and I'm beginning to see a trend from dealers whenever prices get smashed, right? I'm not sure if you're noticing it, but whenever prices are consistently heading down or a big drop happens, suddenly, right, there are tons of sales and discounts off the premium. So you can take advantage of this and stretch your dollar further. But I believe the most dangerous thing to do during this period is to lump sum invest. And that's why I really love dollar cost averaging. There are so many factors that we don't know that could play out. The Fed could tighten all the way to salvage what's left of its reputation, or the Russia-Ukraine war could escalate or end tomorrow. We really don't know, and trying to predict an outcome is quite foolish, to be honest. So if you're still buying, you want to focus on pure risk minimization, and that means dollar cost averaging and really focusing on those big price dips and combining them with dealer discounts if you can find them. Trying to time the market might make you feel like a genius if you get it right, but you don't want to feel silly if prices suddenly turn against you and fall even more. The last thing you want to do is to lose motivation in precious metals and just stop buying altogether, because in the long term, I'm talking about 5, 10 or 20 years, I really believe it will come out ahead. Personally, I believe there's never a perfect time to buy gold. It's either you buy it when it isn't moving and you feel like you're wasting opportunities to invest elsewhere, or you're buying into a rising market and you're annoyed of higher prices, or you get in when prices are crashing and you're worried it's even going to drop more. I'm still buying, but I am scaling back a bit because I already have a decent stack. Instead of buying every month, I'm going to watch what happens and buy once every 2 or 3 months. But the excess money I save is going to be used as my emergency stacking fund. And if I see precious metals suddenly get smashed 5 to 10% in a day, I'll average in a little more. And right now, I'm looking around for distressed gold. I believe there are going to be a lot of people who are panicking and they are over leveraged in their lives, and they'll gladly let go of their gold as spot price to raise cash. Now, those are going to be my primary targets and even better for me. And of course, with the market so unstable, I cannot justify paying any higher premiums, so fractional gold coins are out of the question for me. So if you're still accumulating some physical gold, be sure to minimize your risk. There's truly no good or bad time to buy, and the price could just as easily slide down tomorrow as it can go back up. And right now, we're at a very dangerous point and uncertainty is really high. Inflation is high. The risk of the entire market imploding is also just as high. So whether you decide to buy or not, you need to be really comfortable when making your gold purchases. Don't use up all your dry powder at once and understand you cannot time the market, guys. There are just too many factors here at play, and I really think there will be a lot of headwinds for gold and almost every asset class for the next 12 months at least. So let me know what you think. Are you still buying gold or scaling back a little during this period? Let me know in the comments below. And if you enjoyed today's video, be sure to smash that like button and subscribe for more gold, silver and finance videos. Thank you all for watching, and I'll see you soon.